In this question, what we've been told is that ABC Limited purchased a machine or hire purchase from HMT Limited on 1st April 2016. So here, ABC Limited is the purchaser and HMT is the vendor. And the transaction is taking place on 1st April 2016. So please note, we are following the financial year. The cash price of the machine was 37,250. The details of the purchase are as follows. On signing of the agreement, rupees 10,000 was paid. So rupees 10,000 in this case is the down payment. Balance was paid in 3 installments of rupees 10,000 each at the end of each year. So at the end of the financial year, you're making a part payment and the part payment is rupees 10,000. 5% is charged by the vendor. So interest that is charged by the vendor is at 5%. Mr. Ashok decided to write off 10% depreciation annually on reducing balance method. So here in this case, so it's not Mr. Ashok, it should be ABC. So here what is happening is that the purchaser has decided to charge the depreciation based on the reducing balance method. So reducing balance method is one of those methods which are applied when it comes to computation of depreciation. Pass the necessary journal entries in the books of ABC Limited under the asset accrual method. So please remember the journal technique that we are following for preparation of journals in this case is called as the asset accrual method. So let's start off with the preparation of the journal entries for this particular question. Before we start off with the journal entries, it is mandatory for us to work out certain calculations. There are certain calculations that we have to do. We have to calculate the interest that we have to pay each year, and then we will also have to compute the depreciation amount, and only then will we be able to proceed. So let's just work that out. So cash price of the machine is 36,250. Now let's compute the hire purchase price. Now, how do we calculate hire purchase price? Hire purchase price would be down payment. Okay, so this would be down payment plus number of parts into amount per part. Okay, so this is how we go about with the computation of hire purchase price. So let's just quickly work this out. So down payment, how much is that? Down payment is rupees 10,000, and then a number of part payments. We know it is 3 part payments. If 3 into amount per part is rupees 10,000. Okay, so let's just work. Now let's calculate this. So this works out to be rupees 40,000. So rupees 40,000 is your hire purchase price. So the difference between the cash price and the hire purchase price is what will make up the hire charges. Okay, so we have done with the hire purchase price estimation. Now let's calculate the interest. Let's calculate the interest. Now for our interest calculation, we will be starting off with cash price of machine. Okay. Cash price of machine is rupees 37,250. Now from this, let us subtract the down payment. How much is your down payment? Less down payment. So how much is your down payment? Down payment should be rupees 10,000. Okay, down payment is rupees 10,000. Now, please remember, we will be estimating interest on the outstanding amount. So amount outstanding on amount outstanding on 1st April 2016. It's the difference between the two, which is 27,250. Now, to this, we have to add interest. So interest, remember, we will be calculating interest for first year. So interest for first year, let's calculate this. So let's just quickly work that out. Now remember, interest is calculated at 5%, and interest would always be calculated on the outstanding amount. And the outstanding amount in this case is 27,250. Now what we have to do is we have to calculate the 5% of this amount, which works out to be 1,362.5. Okay, so amount outstanding amount due on 31st March 2017. Okay, so this is the amount that you will have to pay at the end of the year, and let's just quickly calculate this. So this will work out to be 28,612.5. Now, what next is less first part payment. Okay, so you're making the first part payment on 31st March 2017, which is rupees 10,000. This is rupees 10,000, and rupees 10,000 that has happened. Okay, so now let's go back. Okay, so now the amount, now that we have calculated this amount outstanding on 1st April 2017. Okay, amount outstanding on 1st April 2017, this works out to be 18,612.5. So this works out to be 18,612.5, and from to this we have to add interest for second year. So interest for second year is how much? Let's just quickly calculate that. So 18,612.5, and that works out to be 930. So 930.625. I'm going to round this off to 931. Okay, I'm rounding it off because else it will be a little difficult for us to proceed with the calculations. Okay. So when you add the interest to this particular amount, please remember what you would be getting is the amount due on 31st March 2018. So this will be the amount which will be due, and so 18,612.5 plus 931, that works out to be 19,543.5. Okay, now from this, let us subtract the second part payment on 31st March 2018. So which is rupees, which will be rupees 10,000. So your second part payment is again rupees 10,000, and let's subtract 10,000 from this. So when you're subtracting 10,000 from this, what you would be getting is amount due on, so amount outstanding on 1st April 2018. And this will work out to be rupees 9,543.5. Now to this you will have to add the interest for third year. Now what is critical or what is crucial over here is that The third year is your final year. Okay? The third year is your final year. Since it is your final year, we will not be calculating the actual 5% of this. Okay, we will not be calculating the actual 5% of this. The reason being, if you end up calculating 5% of this amount, what you would be noticing is that the amount would be higher than uh, the actual amount. Okay, so it'll exceed 10,000. But please remember, your part payment is only 10,000. Okay, so in order to comprehend that issue, what we would be doing is we would be taking the difference. So how do we calculate the interest for third year? Interest for third year, we will be calculating it as the balancing figure. So 9,554.3 minus 10,000. Okay, so that is your balancing figure, which works out to be 456.5. Okay, so amount due on on 31st March 2019. Okay, 2019. This works out to be rupees 10,000 less third part payment on 31st March 2019, and this works out to be exactly rupees 10,000. And when you take the difference between the two, you would notice that the balance amount is actually 0. So balance amount is actually 0. Okay, so with that, we have completed the interest calculation. Okay, we have calculated the first set of computation, which is the interest calculation. Now that we have calculated the interest, we have worked out the interest for the different years. Now what we have to do is we have to work out the calculation of cash price in part payments. So let's check out for first year. So first year, we know that your part payment is rupees 10,000. Okay? We know that your first part payment is rupees 10,000. And we also know the interest for first year. So the interest for first year is 1,362.5. Okay? So when we do so, the cash price component, okay, in this, the cash price component will work out to be rupees 10,000 minus 1,362.5. So that will be rupees 8,637.5. So what this means is that out of 10,000 rupees that you're paying for the first year, 1,362.5 is going towards interest. The remaining 8,637.5 is going towards the cash price. Similarly, let's work out for the second year. Second year, your part payment is rupees 10,000 minus rupees 931. Okay, and when you work this out, you would notice that your cash price component is 9,069. Similarly, for third year, let's work out for third year. Third year, it is rupees 10,000 minus rupees interest is 456.5. So what will happen is the cash price component would be 9,543.5. So this is your cash component in the third year's cash price component in the third year's part B. So we have completed the calculation of interest. We have completed the calculation of cash price in the part payments. Now we have to go about with the calculation of depreciation. Okay, we have to go about with the calculation of depreciation. Now remember here in this question, the method that we are following for depreciation calculation is reducing balance method, and what we are following is the depreciation is calculated at 10% interest. Remember, depreciation is always calculated at cash price. So cash price of the machine will work out to be rupees 37,250 less depreciation for first year. So depreciation for first year would be rupees 10% of 37,250, which will be 3,725. So this will work out to be, so balance So after first year's depreciation computation, you would notice that the value of your machine would have come down, and it would have come down to 33,525. So now you have to calculate the depreciation for second year. Now, when you're calculating depreciation for second year, remember you will be calculating depreciation on this amount, which is 33,005, which will be 3,352.5. So now value of machine for third year. Okay, value of machine for third year. This will work out to be 30,172.5. Now what we have to do is we have to calculate the depreciation for third year. Now, third year, when you're calculating the depreciation, you will have to calculate it as 10% of the outstanding amount. Okay, so now the outstanding amount will be rupees 3,017.25. So that is your outstanding amount, and we have completed the depreciation calculation for all the 3 years over here. So with that, we have completed the depreciation calculations as well, according to reducing value method. Now that we have completed the journal calculations, we have to now move on with the preparation of the journals. And remember, we are preparing the journal entries from the point of the purchaser. The technique that we are following is called as the asset accrual method. Now, the very first entry that you will be passing is for the down payment. Okay. So when you're making the down payment, please remember a portion of the asset is coming into your business. So machine account debited, amount here is 10,000. Now it can be either bank account or cash account. So in this case, I'm using this to be cash account. Now, the second journal entry you will be passing it on 31st March 2017, and this will be for payment becoming due. Okay? So the payment will be due to the landlord, and for that, what we would be doing is machine account debited. Okay? So we have to notify the cash price. Cash price is 8,637.5. Okay. Then interest account debited, and then the interest is 1,000. So interest over here is 1,362.5. Okay, so this is your interest for the first year. So that interest also we will have to put in over here. So it's 1,362.5, and the total of this is becoming due to the vendor. Now in this case, our vendor's name is HMT. So to HMT Limited. So HMT Limited account, and the total will work out to be rupees 10,000. Now let's write the narration. Being part payment due for first year. So this has been completed. Now what is the next entry? The next entry will be for payment of the part payment. So HMT Limited account, and HMT Limited account, this is rupees 10,000 to cash account 10,000. Let's write the narration. Being payment of first part. So this has been okay. So we have completed this. Next entry is for charging of depreciation. Depreciation, how do we charge? Depreciation account debited to machine account. Now depreciation for first year, this will be 3,725. 3,725. So this is depreciation for first year. Next is 31st March. Profit and loss account debited to interest account. So interest is 1,362.5 to depreciation account 3,725. So this will be 5,087.5 being profit and loss account. So we have completed the journal entry for first year. So the very first entry was for payment of down payment that we have completed. The second entry was for the interest and the part payment becoming due, which comprises of the machine's value and the interest value. Third journal entry was for the actual processing of the part payment. You're releasing the payment to the vendor, and post that you have to charge the depreciation. So the depreciation account debited to machine account. And then finally, at the end of the financial year, while preparing the final accounts, you have to transfer your expenses to the profit and loss account. We've completed this for the first. Let's move on to the next financial year's entries. The next set of financial year's entries will be happening in the financial year 1718. Now, the entries for 1718, it will be becoming, it will be taking place on 31st March 2018. So on 31st March 2018, what would be happening is, at first, the part payment has to be due for the second year. So it will be machine account debited, and the amount over here would be 9,069. Interest account debited, and this will be 931 to the vendor, which is HMT limited account, and then this will be rupees 10,000. Being part payment due for second year. Now, the next entry for 2018, this would be for releasing of the part payment to the vendor, which will be HMT limited account debited to cash account. Being payment of second part payment. Okay, so that has been released to the vendor. Then 31st March 2018, you will have to charge the depreciation. So depreciation account debited, and we'll have to look out for the depreciation, and these are the depreciation amounts that we have calculated. So if you notice the depreciation for second year, this will be 3,352.5. So this is the depreciation for depreciation account debited to machine account 3,352.5 being depreciation for second year. Depreciation for second year. Then 31st March 2018, we will have to transfer all the expenses to profit and loss account. So profit and loss account debited. Okay. Now, what are the expenses that we have to transfer? We will have to transfer interest to interest account 931 to depreciation account 3,352.5 So the total expenses that you will have to be transferring is 4,283.5. So this we have transferred. So we have transferred all the expenses for second year to the profit and loss account. Similarly, we'll have to work out the entries for third year. So the third year's entries will be taking place on 31st March 2019. So on 31st March 2019, let's look at the transactions. Machine account debited. Okay, so machine account over here, the amount is 9,543.5. Interest account debited 456.5. And this is becoming due to the vendor, which is HMT Limited account, which is 10,000, being part payment due for third year. So this we have completed for the third year. Now, post this, what we have to do is we have to make the payment. So 31st March 2019, HMT Limited account debited 10,000 to cash account 10,000, being payment of third part. Then 31st March 2019, depreciation account debited. Depreciation for third year would be 3,017.5. 17.25 to machine account, and so we've charged depreciation for and finally the third year's expenses has to be transferred to the profit and loss account. Now, what are the expenses we have to transfer? We will have to transfer interest account, profit and loss account debited. Interest account would be 456.5, and then to depreciation account. And how much is depreciation account? Depreciation account would be 3,017.2. So this would be expense transfer. So this is the expense transfer to the profit and loss account at the end of the third year. So with that, we have completed the journal entries for 3 years according to the asset accrual method. This technique is called as the asset accrual method.